Well, Investors Club, I'm your host, Timo Wunderlich. Let's get right into it with VIC readings, the form of a look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have SANDRIDGE Energy Inc., ticker is SD, price at the point of filing is $15.33. Let me first say this is not a recommendation, not advice. Please do your own diligence before investing into anything, and let's get right into it. Description: SD. Thesis: SD is the lowest risk vehicle for smaller investors to own natural gas assets and, to a lesser extent, the deep value available in all energy assets. Despite the much lower risk, I believe the upside is likely as great as any non-distressed gas opportunity in the public market. SD is well known to many investors and has been written up on VIC in the past. Since the initial write up, I believe the company's transformation warrants another look as its prospects have evolved. As these assets are generally low quality and merit little development, so I won't spend too much time on a detailed analysis of their mid-con assets. Within the mid-con, the company's misaligned position is a gassy formation that is in terminal decline but throws off a tremendous amount of cash flow. In addition, the company is Ackreach in the NW stack, which is slightly higher quality and merits development if oil is above $80 and gas is above 4. The Ackreach gives the company optionality to bring on limited new production when prices rise, and it can hedge 6 months of prices above those levels. Why is SD interesting given its terminal outlook? I will list the virtues of SD versus other smaller and even larger E&Ps. Number one, SD is the lowest G&A cost per BOE in the public space. This is an area that I feel doesn't get enough attention from investors. G&A is only 8 million per year versus 191 million EBITDA and 121 million FCF in 22, or less than 4% and 6.7% respectively. This allowed the company to convert 63% of its EBITDA to FCF in 22 while spending enough on capex to keep production flat. This EBITDA to FCF compares favorably to even the best-in-class giants such as PXD at a 66% EBITDA to FCF conversion rate in 22. SD, number two, SD had a net cash balance of 257 million at year-end and likely generated 50 million in FCF in the first quarter. Its cash balance is currently sitting at 275 million. With 37 million shares, it currently has an EV of 290 million. I estimate 23 FCF of 70 to 75 million at 75 WTI and $2.50 net gas, or roughly 25% FCF yield. 3. SD has 1.6 billion in NOLs that will shield its FCF from cash taxes, but more importantly, gives the company a huge advantage in purchasing other FCF flowing assets and utilizing its enormous war chest. 4. The company's board is controlled by ICahn, appointed directors who act as his agents, scrutinizing any strategic use of its cash and NOLs. Management is young and comprised of an operationally oriented CEO and CFO who are likely not involved at all in making any strategic decisions. It has been painful to hear investors ask them strategic questions on conference calls when it's clear they have zero input and are hired hands to run day-to-day operations. 5. Private energy assets trade at lower valuations than public despite the extremely low multiples we see in public markets. OVV recently announced the purchase of what is considered a high-quality private E&P for 2.8x EBITDA and 19% FCF at 330 strip pricing. Low-quality private energy assets are trading at 2.5x EBITDA and 25 to 30% FCF levels. This sets up for an enormously accretive acquisition, especially with nat gas prices collapsing. 6. SD has set up a tax asset preservation plan to prevent anyone from acquiring the company at a low premium and triggering Section 382 change of control provisions that would eliminate its NOLs. This plan also prevents ICahn from boosting his stake by more than 50% of his current 13.1% stake, and as such, the shares have remained relatively cheap, as the 50% increase for him would mean very little for him monetarily and would likely trigger a big surge in the stock. Modeling the company's financials is fairly straightforward and highlights the company's enormous resilience to lower prices. As we can see, the projections above show the enormous FCF potential at current strip prices, which include $2.50 per gas strip. It is my belief that at $2.50, 10% of the US gas production from dedicated net gas shale regions will fade, as these prices are not profitable at the margin. It will likely take 6 to 12 months for operators to adjust production lower, as the record production we are seeing is being produced by capex plans made 6 months ago when prices were triple current levels. For illustrations, I have modeled FCF at $60 oil and $2 gas, which I don't believe are sustainable. At $60 WTI and $2 net gas, and SD continues to remain highly cash generative. The latter pricing scenario, above where crude drops up dramatically, would actually serve longer term shareholders better, as SD would likely be able to deploy its cash in a highly counter cyclical way and purchase assets in distress. Conclusion: SD shares offers investors a highly predictable FCF stream that is very resilient to lower energy prices. Public investors are getting an opportunity to partner with a counter-cyclical operator that is strategically run by disciples of one of the best investors in the world, in ICahn. The company is run by owner-operators who convert as much of its EBITDA to owner FCF as possible in the public space. One need not be bullish on net gas prices to achieve a very high return. The investment thesis here condenses into whether we believe ICahn's disciples will make wise use of its huge and growing cash hoard in a world where energy assets trade like stranded assets with no value beyond the next 5 years. Risks: demand for oil and gas is at a peak and falls dramatically over the next 5 years. Catalyst: large acquisition of profitable, likely private energy assets to utilize NOLs and its cash hoard, followed by large stock buybacks. Thank you very much for tuning in. See you next time. Please write down in the comments below what you